Historically, Bitcoin rarely makes V-shaped bottoms outside of, say, like COVID stimulus type of events. Normally, it hits like a low level and then goes sideways for quite a while. I think we're in more of a grind, but a grind could literally be 10K lower or it could be 20K higher, and it's still in that grinding part. So I don't really have kind of foresight on exactly where it's going to bottom. I think it'll be a process that takes time. The derivatives part is like inevitable, meaning that once an asset's this big, there's no world we have a multi-trillion-dollar asset that is kind of magically only owned by retail. Institutions are going to get in if it's successful, and that's something it has to go through. I think that unlike gold, where the paper games can go for literally years or decades because taking custody of it is so challenging and costly, those paper games go a long time till they break. And in Bitcoin, because it can be tested so quickly, whenever there's kind of a whiff of insolvency, it's pretty easy to test.
Every major bull market has a defining characteristic. In its early stages, it feels asymmetric. In its later stages, it feels crowded. And eventually, it feels ordinary. Lyn Alden's recent macro assessment of Bitcoin centers on a subtle but powerful observation. This cycle did not feel extraordinary. Bitcoin performed well. It crossed six figures. It attracted institutional capital. But it did not dominate the global financial conversation the way it once did. It was not the only asset outperforming everything else, and that matters. Before we go on, please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this. Every action helps with the YouTube algorithm and greatly supports the channel's growth. Thanks for your support and enjoy the video.
There's been the bull market was fairly weak. I think what attracts retail a lot of times is when you have an asset that's outperforming every other asset in the world. And people say, well, I have to learn more about that, what's going on there. But when you have RAM stocks soaring and GPU stocks soaring and other kind of AI related things soaring, when Bitcoin is like doing okay, when it was, going over 100K, it was a fine market, but it wasn't like a unique thing, at least in terms of price action. So I think that was kind of, that was probably a downward force on getting retail in this time. I try to avoid price predictions, but I was on record saying anything under 150K would be pretty disappointing. We only got to 126. It's hard to say exactly what I think one is that what I mentioned about the AI drawing a lot of attention. And I'm not the first person to point that out. I think it's competing for attention with assets that are performing as well or better than it over the past few years. I think the precious metals bull run also kind of drew some attention. And like I said, the lack of any sort of broad crypto thing, like often as noisy as that is, it kind of gets a lot of people's attention. It's just basically, other than meme coins and some kind of financial nihilism going on, there wasn't really anything happening there. And I think a lot of people have kind of heard about Bitcoin at this point. So, I just think there wasn't. It's almost like there's a barbell. So, and the two sides didn't show up. So sovereigns didn't really show up. People were talking about the strategic Bitcoin reserve a lot last year. I was on record saying I'm not going to, expect that really. And then the other side is retail didn't really show up. And instead, the only real players this time were kind of in the middle, the corporate institutional side, kind of higher net worth retail that have a brokerage account, and the ETFs opened up to them, made it easier. But not really like a deluge of people buying Bitcoin, taking self-custody of it, learning about it, doing the whole podcast circuit. That was kind of absent this time. Well, we'll see how low we get. But I think, the larger the asset gets, the more liquid it is. It's harder for any one entity to really move the price around. Not like one failed exchange. There's still some really big kind of groups out there that own a lot. But for the most part, the bigger it gets, the less that's able to happen. And I think the derivatives part is like inevitable, meaning that once an asset's this big, there's no world we have a multi-trillion-dollar asset that is kind of magically only owned by retail. Institutions are going to get in if it's successful. And that's something it has to go through. I think that unlike gold, where the paper games can go for literally years or decades because taking custody of it is so challenging and costly, those paper games go a long time till they break. And in Bitcoin, because it can be tested so quickly, whenever there's kind of a whiff of insolvency, it's pretty easy to test. So I think derivatives and stuff, while they can kind of inflate quote unquote supply and IOUs for a period of time, I don't think that's the chief reason. I think mainly just the top line demand was kind of mediocre or this cycle. And I think that played the biggest role in not having the explosive upside. I do think it's healthy not to have those kind of, say, a 20x run and then a 90% crash. I mean, that's inherently part of a smaller asset that generally behaves like that. Yeah, I view them as just less asymmetric now.
Okay.
When you could buy silver for like $18 an ounce, it just kind of was at a period where it couldn't really realistically go much lower and stay there for a long period of time. There's plenty of like industry demand for it, and then there's also, you know, the monetary or speculative component that can happen too. So it's like, you know, I wasn't sure when it would take off, but I was like, I'm willing to let this go for a long time because the floor is pretty high and the upside is pretty significant. And same thing with gold and platinum. And they, you know, gold took off earlier. Silver and platinum were disappointing until they kind of caught up all at once. But now after they've soared, it's more like I wouldn't be surprised by a 50% pullback or new highs again, because it's like, it's just less asymmetric than when they're all kind of, you know, near their mining costs and, you know, when they're very underowned. I think it's just a matter of probabilities or timelines. I mean, I would not have guessed that we'd be at 5,000 gold, roughly speaking, right now. I mean, as someone who's long it, I'm happy we are, but I would not have, you know, if you asked me a year ago, do you think gold would be 5,000? I'd be like, well, no. So it can always surprise you the upside. I think one thing that's worth keeping in mind is that $10,000 gold is only a double from here. Meaning that even if that view is right, and it very well could be, it's a double, right? So you're taking on downside risk if it drops back down to 4,000, 3,000 an ounce. And that's, you know, offsetting the fact that it absolutely could go to 10K, could go to 15K, but then you're looking at 2 or 3 multiples. So it's not that I disagree, it's just that asymmetry is gone. Now, if gold does kind of revalue toward the kind of the global central bank store of value, those are the types of prices that would make sense for it. I mean, he's been really good at calling like the gold to oil ratio specifically. That's absolutely played out. I think we're near record highs in that ratio, kind of ignoring the brief time it kind of oil went negative.
Yes.
Not all oil markets, but certain oil markets went negative. So that aside, we're kind of near all-time highs. I think that's a perfectly valid thesis. It's just that, you know, when you're looking at a potential 2x or 3x gains, I think you can still spread out your bets to other things because there are plenty of things that can go up 2x or 3x on a multi-year time frame. I see it in fewer places now just because we've already had, I mean, you know, we've gotten pretty high in the US stock market. We've already had precious metals take off. And like I said, I don't know if we're at the top or not, but they've already taken off. You know, I'd like to think that Bitcoin can still go up quite a bit. I mean, it's still a fairly small asset. We saw how, you know, gold and silver could move like they did despite being very large markets.
Yeah, haven't seen that for a while in Bitcoin.
No, I haven't seen that for a while. I still think it has upside, a significant upside potential. And then I go to corners of the market that just don't get a lot of attention, like Latin American bank stocks and stuff like that. I mean, they were one of the best performers in 2025 and no one, you know, they're completely off the radar of anything. No one would have on their bingo card that like during a trade war, Latin American banks do amazing, right? Like, you know, the biggest bank in Brazil, the biggest bank in Colombia, they were up a ton. Kind of like gold and silver, I think a lot of the run is over now, but I still think that there's in that region, and kind of parts of emerging markets, not all emerging markets, but I do think that they're kind of set up for probably a pretty good forward 3 to 5 year performance.
One of the defining features of this cycle has been Bitcoin's correlation with software equities. Algorithms increasingly treat Bitcoin as a technology asset. When software indices sell off, Bitcoin often follows. When AI narratives dominate capital flows, Bitcoin competes for allocation. AI adoption is immediate and tangible. People can see how it enhances productivity. They experience its utility directly. Bitcoin, by contrast, often functions as financial insurance, valuable but not urgently necessary for many users in developed markets.
I think initially, kind of like the diamond hands put the floor in, which is to say that the fast money gets out, the coins rotate from fast money hands to strongly held hands that are really not going to want to part with it unless it goes up like 5x or more, basically that kind of buyer. And then eventually it tightens supply. And then it only takes a marginal amount of new demand to come in. It could be, for example, that the AI stocks eventually just peak. They get so silly big that they can't really get realistically much higher. And then Bitcoin's cheap for a while, and it's in strongly held hands. And people start to notice that, hey, it's going up again, and it's under-owned, and no one's talking about it. And then, of course, bull markets kind of feed the narrative after that point, kind of like we saw in precious metals, where once it starts running, then people hop on. I don't think we've seen the end fully of the treasury company buying spree, which is to say that, obviously, I think some of the MNAs we're not going to see at the level that we saw in 2025. But I think some of them will be still buying in the years ahead, like Strategy and others. And then when you do have that rising environment, people look around and say, well, how can I lever that in the least risky way? And they might look at some of the treasury companies and bid those up. And if they get a positive MNAV, they can buy. So I think that's kind of part of the bull markets going forward. I mean, I started back in December and January, I was working with the assumption that the November bottom, might be the bottom. That was kind of my base case, but we invalidated that case. Historically, Bitcoin rarely makes V-shaped bottoms outside of, say, like COVID stimulus type of events. Normally, it hits like a low level and then goes sideways for quite a while. I think we're in more of a grind, but a grind could literally be 10K lower, or it could be 20K higher, and it's still in that grinding part. So I don't really have kind of foresight on exactly where it's going to bottom. I think it'll be a process that takes time. Yeah, in that report, I mean, at the top of my head, I think it was 83% of the time it goes in the direction of liquidity, and the other 17% it doesn't. The most common reason it doesn't is because of valuation. So when you have a very high, let's say, market cap compared to like average cost basis, so you have a very big disconnect, you're more likely to get a divergence where liquidity and money supply are still going fine and Bitcoin's selling off, just because a bubble can't necessarily, a local bubble can't be maintained just because liquidity is still decent. This has been one of the 17% of the time where it's kind of gone in different directions. I think in large part it's because of that shadow of AI, that there are other things for that liquidity to want to go into. And then there are other proprietary measures of liquidity, like cross-border capital, for example. They've got their own more proprietary data. For our article, we wanted basically publicly available data, which comes with limitations. Whereas if you have a proprietary indicator, it's hard for other people to go check it, but it can potentially yield more accurate results. And for example, he's been arguing that liquidity is not going up right now, that it's actually more strained than it looks. And that's certainly possible. There are still a number of central banks that are reducing their balance sheets. The kind of the tightening of the Japanese bond market is a downward force because they're a major creditor nation. So we're not really in like an explosively positive liquidity environment. There's some debate about how good or bad it is, but it's not amazing. And like, some of the more risk-on things you see, like when PMIs, like purchasing managers indices, are going up and the economy's kind of raging, we don't really see any of that in this period of time either. So a lot of assets that are outside of like the AI sphere are kind of grinding, and you get random winners and random losers, like Latin American banks somehow doing amazing, AI stocks obviously doing amazing, and other things not. And then lately, Bitcoin's been correlated to software stocks to an unusual degree.
And those have been selling off. Yeah,
they've been selling off. I think somewhat rationally, but I think eventually they'll get oversold and they'll be buying opportunities. And then it's possible that the algos just jump on. The trading algorithms say, well, Bitcoin's software, right? And then they kind of trade in sympathy with each other. I would say there's two parts of the thesis. One is that a decentralized ledger is valuable, and that it's more valuable than, say, its current 0.2% of global assets. People can debate what that number is. A bull would say whatever number it is higher than 0.2%. It could be a 2% is a 10x, 20% gets you to 100x. So it's like, okay, well, if you're higher than 0.2% on the kind of the total addressable market, then there's a bull case, at least over many years, not any given 6-month or 12-month period. The second part is basically arguing which one then. Bear might say, well, they'll fracture and there'll be 10 different popular ones and none of them will get big. Someone who focuses on network effects, however, will generally argue that, basically that one is going to win, basically Bitcoin. And that part of the thesis has been strong lately. I mean, we had basically no alt season outside of little pockets. The second biggest cryptocurrency has not made a new high in Bitcoin terms since like 2017. It's only 20% the size of Bitcoin. So I think Bitcoin 17 years in is firmly kind of winning that network effect and security argument. And the part that just still remains challenged is that top line demand. You know, what is the like level of demand for a decentralized ledger? I would argue that it should be higher than it is now, but obviously the market has disagreed. There just has not been a lot of buying pressure. And I think, you know, people used to like to point out how often it took the internet to catch on and then Bitcoin catching on quicker. Well, that narrative's damaged because AI just came and you know, people could see right away how this could potentially help them. And a lot of people, because Bitcoin's kind of use cases are often not like needed immediately, right? Obviously, some countries are needed immediately, or if someone gets debanked, they're needed immediately. But for a lot of people, it's more like insurance, where they don't really necessarily even know they need it. And I think that kind of slows down its adoption. So I think the thesis is still sound that a decentralized ledger is attractive and probably worth more than 0.2% of global assets. And certainly that second part is stronger than ever. That kind of the fact that Bitcoin is kind of unique in this regard compared to the long tail of other cryptos. But that top line demand has just not been here this cycle.
This cycle did not deliver a euphoric retail frenzy. It did not produce sovereign adoption at scale. It did not generate a 20x explosion followed by collapse. Instead, it delivered institutional participation, moderate upside, and structural consolidation. That is not a broken thesis. It is what maturation looks like. Bitcoin competes for capital in a world where AI dazzles, gold revalues, and liquidity is mixed. Its network effect remains intact. Its long-term addressable market remains far larger than its current share.